Hi, it's Michael Farr at Farr, Miller and Washington. I'm looking at the situation domestically this week, and I'm looking at Europe. Jobless claims in the U.S. went up this morning. More people having jobless claims, more people are unemployed. We saw the consumer price index fall, which means less inflation. There's no real inflation out there. In fact, it fell below the Fed's notionally targeted rate. We don't have a clear target yet out of the Fed, but we've got this sort of soft rate there. So we're not seeing any robust growth here in the U.S. and no real inflation. Combined with the situation in Europe, the unemployment situation, the Federal Reserve now is in a position where it might be encouraged to do something more. Mr. Bernanke might want to come up with an additional Operation Twist. Federal Reserve President Evans is calling for more twist so that they can continue this new program they've got that's supposed to end here in June. Or we get QE3, or we get something else to try and get things going. My question and my concern, as we look at a 10-year Treasury that's trading around 1.6, 1.65%, and you have mortgage rates at 4% or less, and there's something like 14% cash on the balance sheets of all the S&P 500 companies. There is an enormous amount of cash available in our system right now, lots and lots of liquidity. If you add this stimulus, how much lower are you going to bring rates? And if you bring rates from 1.6% down to 1% flat, and you have a 60 basis point reduction in rates, and you lower mortgage rates by another 0.6%, is that really going to do anything stimulative for the economy? Are you going to accomplish anything really organic that's going to get more growth for that 0.6%? Clearly, I don't think so. What I do think is that you will get a pretty good reaction out of market participants, and I think you'll see as much as a 20% pop out of the stock market in a relatively short period of time should the Fed intervene. It will not be a pop that's based on fundamentals. You're not going to see a 20% increase in earnings, fundamentals, sales, revenue growth, balance sheet growth. That won't happen. But the support and the inflation of that additional pool of money has had that reaction in the market. I think we'll have it again. If you're an investor, how do you think about that? I would suggest, as I tell our clients at Farr, Miller and Washington, that what you need to do is own good, solid companies. Companies that are seeing their earnings increase organically in ways that you understand, that have solid balance sheets, good dividends, lots of cash, and can be defensive. Europe is a significant trading partner for the U.S. and for Asia. As they slow down, and we're seeing China trying to stimulate things in their economy, which is much more closely than our economy is managed, much more closely than our economy is. And here again in December and January, we face our own fiscal cliff where we have to go through our own austerity. You've got three basic areas of government all trying to spend a little bit less, lower the valuation of their currency so they will be more competitive worldwide. And by the way, when you get 50% of the world's economies, which the U.S., Europe, and Asia, China represent, all trying to lower their currencies at the same time, it doesn't work. You can only lower relative to. This is a race to the bottom where there are not going to be any really fun or clear winners. But anyway, all of this trying to stimulate, when people are contracting, they're contracting. You can't make chicken salad out of chicken feathers. You can't get an expansion out of a contraction simply because you will it to be so. I'm reminded of the final words of the Wicked Witch of the West. What a world, what a world. I can hear them saying it in Greece as they melt down right now. What a world, what a world. How did that bucket of water ruin all of this good wickedness over here? One thing that the Wicked Witch knew was that time was up, and there was no going back, and there were no alternatives, and somebody else was walking out of that castle with her broomstick. I'm afraid the Greeks are going to find that out. I fear that Spain and Italy are going to become more part of this story. Our investors need to be circumspect, disciplined, dogged, and really, I think, conservative and defensive. That's what we're doing. That's what we're advising. I think it makes sense. When you see these jumps as a result of some Fed comment or some money insertion from some central bank around the world, you will see volatility go up and you'll see riskier stocks perform very well. Don't get sucked into the short-term performance. Stick with your long-term plan. Money's too hard to make. This is a great country. The U.S. will get through this, but I don't think it's going to be fast. I don't think it's going to be easy. Keep your powder dry. This too shall pass. If you need a little help, please call us. If you know anybody who needs help, have them call us at Farr Miller in Washington. We can help. For Farr Miller in Washington, I'm Michael Farr.